Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com looks at the record-setting meltdown on the major markets. He believes it could take some time for it all to shake out, but there will be opportunities along the way. The publisher of the Leibovit VR newsletters, Mark Leibovit, talks about the impact of the coronavirus on the markets. He believes no matter what in the long run, the U.S. equity markets will bounce back because they're the best game in town. CEO of InsideTrackTrading.com, Eric Hadik, looks at how various cycles are working in the markets and how we just hit a perfect storm of market and disease cycles merging together. Plus, at the end of the show, we'll have company showcase updates from American Manganese President Larry Reaugh and Aben Resources CEO Jim Pettit. We'll talk to Ross Clark right after this.
Cypress Development Corp is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at ChartsByRoss. Welcome back to the show, Ross.
Well, it's a pleasure to be back with you, Jim. And just when you think you've had one for the record books, then they toss an even bigger one at you.
Right, and I just remember a month ago where we were going, oh, ho-hum, another record high in the stock markets. Yeah. Not so ho-hum anymore. Yeah,
and we knew at the time, we talked about how, some of the indices just weren't participating, and transports weren't, and the New York Stock Exchange Composite wasn't, but there it was. You still had the utilities moving along. The S&P was holding up, and the FANGs had given up a little bit of leadership to other stocks in the NASDAQ. But overall, it was starting to look a little heavy. And wow, all you needed was the catalyst. And who knew that 2 or 3 months ago that it was going to be the corona here. But at this point, the COVID-19, this is clearly the one that's got everyone concerned. And this is, forget about, price levels and how much break we've had so far and whether it's over. The fact is that something like this takes time to work through the system. There are so many adjustments that have to be made. And from a price perspective, me, I look at my charts and try and ascertain what's going on from that. And the breaks that we have seen this week, and it all started, it seems like it was months ago now, but Saudi Arabia and Russia, that oil production standoff, that was only last weekend. Yeah, and you get oil breaking from the mid-40s down to just under $30 in a span of one night, then causing concerns and ripple effects. Type of thing that you don't see that often, and I've been around too many years, and even for me, this was a strange one.
As Disney said, it's a small world after all.
Yeah, this. Step by step. So $30 oil now makes U.S. shale production just uneconomical. And these companies that are down there that have been doing the fracking, the amount of money that they've borrowed, the leverage that's in them, just the unwinding of that becomes so hard as far as the whole bond market is concerned. You got the high yield bonds, have been up around 88 on the index 2 weeks ago, sold down to 77 this week. That matches the lows that we saw 2 years ago. On the other side of the coin, you got the government bonds, the 30-year bond yield got down to levels that we haven't ever seen. And looking at a chart of the bond price, the Treasury bonds, it got to the top end of a 20-year or 40-year channel, the highest RSI up over 72 that we've seen in ages. We had weekly sell signals out there, and this has just crashed and burned in the second half of the week, because you've gone from a mode where the flights to havens, in particular being gold and bonds, in the early part of the week, have reversed dramatically. Gold price, at times of conflict or times of crisis, inevitably have these big spurts to the upside. And then the backside of that is that once those buyers have stepped in, and there's a huge vacuum underneath. And after the attack against Salami a couple of months ago, we had an upsurge and a small pullback. This time around, we got up to $1,704 in gold on Monday, Tuesday, and by this Friday, we're down to $1,504, $200 break in the price of gold, as there was just no follow through on the upside, and everybody ends up quickly going for the sidelines. The big one to me, though, has been the equity markets, because we had been talking about this seasonal high and the presidential year and all those normal things, and looking at key support levels and what would happen. And we're looking at the fact that this was an 11-year bull market from March of 2009 into the end of February of this year. When we look back, the markets that rhymed with this one or mimicked this were the decade-plus moves like you had in the 1950s into 1961. Then you had them again 1974 to 1987. Then you had the run from the 87 low up into 2000. Each one of those was followed by a 38% correction of the rally. In some cases, that became the final low before you moved up, like in 1962 and also in 1987. But that 38% level was really, for us, one of the magnets. As soon as you started to crack here, that level was really potentially coming into play. And on Thursday night, the S&P managed to get down right to that point, giving back 38% of the whole run since 2009. The same thing as far as the New York Composite was concerned. It's the spot from which you can expect a really good bounce. But this is probably just a bounce. And it doesn't matter whether the U.S. declares an emergency here, the president, national emergency. The fact is that this is going to take time to consolidate, form some type of a level from which you might be looking for an advance. But from my perspective, we've got some really good trading opportunities as we move ahead here. In pretty much everything, whether it's bonds, gold, or the stock market. And it's the type of thing that if you're on top of, you can take advantage of. And when we come back around to test the lows that we had on Friday, that will be, I think you look at that like the 2008, 2009 market. Everything got hammered into October, November of 2008. You had a nice bounce. And then when we went back down into March of 2009, the financials got hit really badly for that second time around. But a lot of other stocks, a lot of other sectors, in particular the NASDAQ, a lot of those tech stocks started to hold up extremely well. And that is what I think you want to be looking for as we move down the road. Not so much, where are the ones that are most oversold and going to bounce back. Those are great trades. But for a buy and hold, you want to be taking a look for where the resiliency starts to step in. And you're bound to be a lot of cuts in dividends as we move along here. But if you can see stocks that are, maybe getting a cut in the dividend and start to hold well afterwards, or just on a relative basis, that's where you're going to want to spend some money.
The Bank of Canada made another emergency 0.5% cut to their central rate. So 1% down in the space of a couple of weeks. Is that unprecedented?
Well, it's unprecedented, but really, what does dropping interest rates do? I mean, in terms of the position we're in right now, I don't think it does much in terms of stimulating activity. You've got to find other ways to do that, things that will get people out and spending, because at this point, they're just going to start pulling in the reins, and it doesn't matter how much how available the cash is for those individuals or corporations who can take advantage of the low rates. Most of them have already been doing it. I mean, it's not as though we've had high rates for the last couple of years. I don't see the move by the Fed as that helpful. If anything, you take a look at it, the open market in terms of the bonds and the T-bills have already made that move. So central banks, whether they be in the U.S. or in Canada, I think are more behind the 8 ball than ahead of it. During this interval that's coming up here, what we'd like to do is we're going to offer a 2-month trial for people. So for $200 for the next 2 months, while this market moves through the consolidation phase and is a bit of this chattery phase, they can see the opportunities as we present them. Ideally, extremes such we've seen present some just major opportunities to step up to the plate. It's usually when people are most anxious about it, but between individual stocks, indices, and options, there clearly should be some major moves that people can be taking a look at. So chartsandmarkets.com, and take a look there for our trial subscription.
Ross, thank you for being on This Week in Money.
Pleasure to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on Twitter at chartsbyross. Coming up, Mark Leibovit next on This Week in Money.
Always consult your investment professional before making any investment decision.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Mark Leibovit, editor and publisher of the Leibovit VR newsletters, also known as vrtrader.com. He was the #1 U.S. stock market timer in the January 2020 edition of Timer Digest. Mark's technical expertise is in overall market timing and stock selection based upon his proprietary volume reversal methodology and annual forecast model. Mark's extensive media television profile includes 7 years as a consultant elf on Louis Ruckhiser's Wall Street Week TV program and over 30 years as a market monitor guest for PBS's The Nightly Business Report. He also has appeared on Fox Business News, CNBC, BNN Canada, and Bloomberg, and has been interviewed in Barron's, Business Week, Forbes, and the Wall Street Journal. In the January 2nd, 2020 edition of Timer Digest, Mark Leibovit was ranked the #1 U.S. stock market timer and was previously ranked #1 intermediate U.S. market timer for the 10-year period December 1997 to 2007. He was a market maker on the Chicago Board Options Exchange and the Midwest Options Exchange, and then went on to work in the research department of two Chicago-based brokerage firms. Mr. Leibovit now publishes a series of newsletters at www.leibovitvrnewsletters.com. He became a member of the Market Technicians Association in 1982. Mr. Leibovit's specialty is volume analysis, and his proprietary Leibovit volume reversal indicator is well known for forecasting accurate signals of trend direction and reversals in the equity, metals, and futures markets. He has historical experience recognizing bull and bear markets and signaling alerts prior to market crashes. His indicator is currently available on the Metastock, eSignal, and TradeStation platforms. His comprehensive study on volume analysis, The Trader's Book of Volume, published by McGraw-Hill, is a definitive guide to volume trading. It's now also published in Chinese. Mark has appeared in speaking engagements and seminars across the planet, including right here in Vancouver. Mark, welcome to This Week in Money.
Thank you. Pleasure being here. Thanks for having me.
Mark, does it look like the markets have bottomed yet?
I think there is a short-term bottom in place. We have some cycle work among a lot of other things that we do. I don't know if the big picture bottom is in place, but they don't always ring bells at the top and ring bells at the bottom. But a lot of our work pointed to mid-March as a potential low, and a lot of reasons for that. So, it's been a little choppy here the last few days, but it looks like a little bit of at least the trading bottom has come in. If it's what we think, it could last. It could be the big bottom, as you suggested, too, but I'm not assuming that for now. But, it could last through the end of March into early April, perhaps. And then we'll just sort of take it from there. I mean, overall, as you know, the market's had a huge sell-off, and there's some real bargains out there. Stocks way overdone to the downside. So for long-termers, it doesn't hurt to do a little bit of buying. You're never going to pick the bottom anyway. But in terms of, a big picture call that we're headed, to new highs all from here, a lot of variables this year. You've got the U.S. election coming up. You don't know where the coronavirus is really going to go in the U.S., whether they're going to halt it or whether it's going to first start accelerating in the days and weeks ahead, and whether you are serious about that virus or not. There are a lot of people that are sort of skeptical that it might be overdone. There might be too many warnings. It may not be as bad as we saw happen in Italy and other places, but only time will tell. But that obviously could affect the markets as well. The fact that sporting events have been cut off, people are not spending money. I mean, a lot of these things have repercussions that are difficult to gauge. So we're in a really unusual time here. So short-term trading bottom, yes. Not sure about the big bottom yet. And we take more of a trading approach anyway. So we're happy since we are long the market here.
This is the trillion-dollar question, at least. What do you see ahead for the U.S. stock markets?
Well, overall, I'm bullish. I mean, the big picture is up. I mean, it's been that way for 100 years. I mean, we get these big shakes. We had over a 20% correction here, and whether it turns out to be a 50% correction and something happens later in the year that we can't foresee at the moment, but ultimately we always seem to come out of these things. So, I'm a bull big picture. I mean, who knows what number you want to put on the Dow Industrials? 30,000, 50,000, 40,000. I mean, all kinds of numbers you can come up with in the years ahead. So only build one place for the markets. Governments have to print money. They all seem to want to do that. Inflation seems to be a fact of life. So I'm not a bear big picture. It doesn't mean we can't have more of a correction later this year. And if the U.S. election turns out that it's not with Trump, I think a lot of people might be sellers, and that might create a problem into 2021. So, but even that ultimately will turn, because we find in history, no matter who is a U.S. president, whether it's a Democrat or Republican, there are bull and bear markets, and crashes and all kinds of things happen no matter who's sitting in office. So it's almost the market has a life of its own. Money finds its way into the markets one way or another. Companies still have to grow and raise capital. There's always new technologies, things happening that drive markets higher. So ultimately we're going to go higher. So we just have to sort of take it a day or week at a time here through this year into early next year. And if we can catch some nice trading swings, we're going to be very happy, and hopefully our clients as well.
Were the stock and commodity markets hit with a black swan?
No question about that. I guess that's the definition of a black swan, some unexpected event out of nowhere that really kills the market. That the virus certainly did that. I mean, there's others that claim there are other issues with the European financial situation and interest rates and all kinds of crazy financial ramifications going on out there. But it's definitely the virus that shook everybody. I mean, it wasn't the European repo market or negative interest rates in Germany or any of those other financial issues that forced people to close sporting events and stop shopping and virtually close the country down. So it's definitely a black swan.
Is U.S. business and the stock market terrifically resilient? Because, up until this one event that tipped the market over, or they claimed that was the cause. But, I mean, we had missile attacks in the Middle East and Russia and China not getting along, a lot of geopolitical incidents that didn't seem to have much of an effect. Is that one of the reasons why you have this optimism?
That's a good question. You're right. A lot of these other things didn't seem to impact the markets. I guess a virus is a scary thing. I guess if an asteroid was headed to the Earth, that would be a similar event where people think it could be the end of the world. I mean, for some people with this virus, they're fearful for their lives or the relatives of the relatives that are elderly. And there's a fear factor here that really hit home that we've never really seen before in the U.S. I mean, in my lifetime, I grew up, I'm 72 years old, so I've been around a while, but I remember when I grew up during the Cuban Missile Crisis when I was a young kid, everybody was building bomb shelters, and they thought the atomic bomb was coming, and Russia and the U.S. were going to go to war, and we all came out of that, but even then, you didn't have the fear level that you have now. We didn't shut down the country. We didn't have the type of economic scare that we had in the last several days and weeks, and it seems that's still with us. So I guess a disease or an asteroid is what does it.
And the thing is, and if you're a real stock market believer, you would bet on the company that's developing the rocket that's going to take out the asteroid.
I definitely would, and that would probably be Elon Musk's SpaceX. I'd probably bet either that or what's the other company? SPCE, the other big company in the space industry. One of those two are definitely going to be beneficiaries, and I think they are working toward that goal. So, but I'm not worried. Listen, I don't think they would tell us if an asteroid was coming, to be honest with you.
On Monday, March 9th, we had a supermoon. Some call it a worm moon. It only had a one-day effect. Can moons, especially supermoons, have an effect on the markets?
Well, it's an interesting question, too, because I have a long history following a lot of various indicators besides my own volume analysis. I primarily use, as you probably know, that's what the VR stands for, volume reversal. I'm more of a volume trader, and I developed that when I was a floor trader on the Chicago Board Options Exchange many years ago. But when I was on the floor, I ran into some financial astrologers who were traders, and I know quite a few of these guys, although they're all over the industry. Many recall some of the big names that have been on some of the big networks over the years. Without mentioning any particular name, I know all of them personally, and I ran into a few of them as a floor trader. So one particular day, I was trading on the floor, and one of them comes up to me and says, at 12 o'clock noon, you're going to see the market change direction, and it's going to sell off. And I said, why do you say that? Well, because he had some lunar cycle that he was looking at. It wasn't based on the stars, but though he's an astrologer, it somehow was tied to what he was doing. And I laughed at him. I said, this is ridiculous. And sure enough, at noon, the market, I don't know, was up. In those days, we didn't have the kind of numbers that we have today in volatility. The darn thing absolutely reversed, switched direction. It was almost to the second. And I looked at him. I said, how did you do that? And, I'm not saying every call he made was that accurate, but it certainly impressed me that he was looking at something that no one else you would think is legitimate in terms of an indicator. You know, we're looking at everything else but something like that. And then you start thinking, so I spent a lot of time researching that. There was also a very famous analyst, a Canadian analyst, you probably know the name, Ian McAvity, out of Toronto, who passed away a few years ago. He was an acquaintance of mine, and he was on the Louis Reaugh television show many years ago. I think it was on in the early 1970s. This before I became an elf on that TV program and got involved with Louis Reaugh. But he was on that show. I remember watching this, and this was even before the trading incident that I just mentioned to you a few moments ago. And he made a big prediction on national television in the U.S. that the gold market would top out on full moons, and I believe he said it would make lows on new moons. And they never had him back on the show again. But I was watching the show, and I said, boy, that's really interesting stuff. And, you know, he was a pretty noted analyst in Canada, and has a pretty good reputation. I think his newsletter was called Deliberations. I don't know if you ever came across his work or met him, but he was a terrific gentleman. And had the pleasure of knowing him. So between those two incidents, I started paying some attention to it, and it's like anything else, you know. You look at your indicators. So what I actually do, and this is from a trading perspective, is I'll actually plot the lunar cycles on my charts as a result of these two experiences that I had. So I'm looking at the Dow Industrials or the Toronto TSX, and I will post on the charts in advance every full moon, new moon, quarter moon. There will actually be a point on the chart. And I've noticed over time that when markets get overbought or oversold into one of these lunar cycles, there's a good chance you'll see a market change direction. Now, it could be a trade for a day, like you just referred to earlier this week, which still could be profitable if you're a trader, or it could be, you know, an intermediate move. Some have been spectacular, where I've seen markets top out right on full moons or bottom right on new moons or vice versa. It didn't make a difference which moon it was, but it's a force in the universe. And when you think about it, you know, our tides are controlled by the moon, and most of our body is made up of water. So if we think we're impervious to the forces of nature, you know, I would say guess again. So, you know, it's just, you know, an interesting phenomenon and something to pay attention to. So it's just one of the many indicators. So I'm giving you a long-winded response, but this is something that, you know, you really don't see anybody talk about or pay attention to, because they think, oh, you got to be crazy to think the moon would have anything to do with the stock market. And maybe it doesn't, and maybe it's just coincidence, but I have to tell you, it's an indicator among many that I have learned to pay attention to.
We'll have more with Mark Leibovit right after the break.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're chatting with Mark Leibovit. Mark, we're hearing the coronavirus is a pandemic. Other people are still claiming that it might be just a hoax. Your thoughts on it?
That's a good question. I don't think it's a hoax. It's a real virus of some kind, whether it was a biological weapon or not, which some claim is the case. It might have been released intentionally, not just an accidental, disease that developed on its own and got spread around. The Chinese are claiming, I just read yesterday, the U.S. Army started the whole thing when they were somehow in China, and how all that happened. And there's other stories that came out of some laboratory, either in the U.S., Canada, or China. But, it's a real virus. It may be, the word or term hoax may be a better way of stating how it's affecting the markets, and if indeed it was set up as a weapon of some kind, and this is pure speculation, of course, but, if that was the case, then obviously there's some forces behind all this that tended to benefit from this occurring. Now, what is that? Is that people on Wall Street who just want to short the market and buy the market cheaper, or is there some other event out there that we're not being told about, and that the virus, though it's real and it does affect people, and I'm not dismissing that at all, is covering up something else that is happening, that the forces that out there, the forces that be, as it were, don't want us to know about yet, or are trying to distract us on some level. And I know this sounds very conspiratorial, and when we get into a lot of theories about what that might be or not be out there, people who are politically oriented say, well, it was set off because they're trying to discredit Donald Trump. And if the economy collapses and the stock market collapses into the November election here in the U.S., there's less chances he'll be reelected. So could forces be that diabolical that actually would have done something like this just to unseat the U.S. president? I mean, that's just one theory that's out there. Or is there something else going on, like, those other analysts are talking about the financial crisis that's going on in Europe with interest rates and with the repo market, and these are areas that I don't have a lot of expertise in, but basically saying there could be a big financial collapse about to happen, and one way to distract people is a disease floating around that would, perhaps then allow governments to become more proactive in terms of what they're now doing. For example, today, on Friday here in the U.S., the President of the United States declares a national emergency. This is really, I don't think it ever happened. It's not in my lifetime. Maybe it happened back in the 1940s during the war, but, something like that is being instituted. It doesn't invoke martial law, but martial law could be the next level. And, there's been a lot of worry on the part of people who are conservative or libertarian that we want less government in our lives, and there are other forces out there that want to see more government and more control in our lives. And was this virus a way of implementing more government control in our lives in a way that might not normally have happened? So, again, this is all speculation on my part. I'm just a little bit of a contrarian, having been in the markets for 40 years, and just an observer of life as well, and just saying that sometimes when things appear to be so obvious in one way, it's not so obvious, and sometimes you have to look into things a little bit and think a little bit on your own. So, again, it's not a hoax, but my gut feeling is that the way the event unfolded and the events that are now unfolding before us sort of suggest to me that there was an ulterior motive to this occurring besides some accidental virus suddenly appearing out of the blue. It may have, again, been a weapon of some kind, or more intentional perhaps on some level than we're giving it credit to or even discussed.
Well, it certainly did stop the anti-Chinese government riots in Hong Kong.
That's a good point. Exactly. So the government, things have happened that would not have happened without this occurring. So you wonder, what other things, what other motive there might have been behind this whole event. So, unfortunately, something like this to even occur, to injure people, cause deaths and whatever, which is the result, is being used as a mechanism for these other events to occur. And I'm just too much of a libertarian and conservative at heart, and protect our freedoms. And when I see something like this, it just worries me that, particularly if martial law is the next thing that is imposed, you just wonder what this was all about. So it is a concern, and I'm not saying I have the answer. There could be some other event that we still don't know about that's out there, and that this is covering it up, and we may or may never find out what that is. So, there was an analyst on, I think I have a note here. I was watching TV yesterday, and I think I wrote it down, and I'm pretty sure I wrote it down. I can find it. He was on one of the national television shows. I think he was on the Lou Dobbs television program on CNN. Not CNN. God forbid it's CNN. That's
Fox.
That's a network I don't want to watch or be involved. I think it was on Fox News. His name was Dr. Michael Osterholm, and he was from the University of Minnesota. And he was just being interviewed on the TV. And out of the blue, he just said, well, we have to fight this thing just like we would have to fight Martians if they invaded the Earth. And that rang a bell with me. In other words, maybe there is, I know people listening to this interview are going to think that I'm totally nuts and they're going to think this guy got to hang up this, close this interview down right away. But is there an extraterrestrial event that we don't know about? And he said it on there. He says, what if we compare this to Martians invading the Earth, and we would have to fight the Martians to survive? We would have to fight this virus. And I fell out of my chair, and one of the slides that I had at the World Outlook Conference in Vancouver just about 30 days ago, I put it up on the screen, and it showed, and this is something I could, it was in my newsletter. I guess I can send it to somebody if they haven't seen it. It was a slide showing the emblem for the new United States Space Force, which, as you know, Donald Trump has created as a new branch of the military. And right next to it is a slide of the emblem that was used in Star Trek, the television and motion picture series that we're also familiar with William Shatner, who's Canadian, as you know, and you look at these two symbols, they were identical. So the United States Space Force symbol, that the emblem that they put on your, I guess, on your shirts or jackets, is almost identical to the Star Trek Federation emblem that was used in the motion pictures and television. And my question is, what the heck is that about? Is there something going on in the extraterrestrial space that first needed the creation of the Space Force? And two, why is it so similar to what we saw in the television emblem someplace else that we would think is unrelated? So when this guy on TV starts saying, gee, we're fighting Martians, if we were fighting Martians, we'd have to do the same thing as to protect ourselves with this virus and take unprecedented steps. So we can get into a whole other discussion about this. I don't really want to go much further with it because people think that I'm totally a nutcase, but there might be something going on beyond the planet Earth that no one would even begin to talk about on financial television or radio and say, God, how can you even think about something like that? You must be nuts. Maybe I'm not so nuts.
Well, they say life came in, particles off an asteroid or something that hit the Earth.
And maybe the virus came from an extraterrestrial spacecraft or from an asteroid or from something from outer space.
You're right, Mark. People are going to start wondering about us.
Right. So that's why we're just bringing this whole thing up about the virus being a hoax. And it's not really a hoax. It's real. But what else could be behind it? What's the real story behind it? Is it part of a cover-up? Is it not part of a cover-up? Is it a political event of some kind? Is it a way to manipulate currencies and money around the world as a cover to actions governments want to take that normally they wouldn't take? Is it something as crazy sounding as an extraterrestrial event? Whether it's a virus that came in on an asteroid, or maybe we're having a repetition of that Michael Reddy film from 1952, The Day the Earth Stood Still, where a alien craft lands. One of my good friends produced the film called Roswell back in the 90s. It was based on that incident in New Mexico. I don't know if you're familiar with that or not.
Yes.
Right. So anyway, he produced the film Roswell. And he actually made a cameo appearance in the film, but he didn't direct the film, but he was the producer, and he was a friend of mine, and we've been in touch over the years, and he shot this thing, and he said they interviewed about 300 people in the area, and he said there's no question about the incident having occurred, and it was a huge government cover-up. He said witnesses that he interviewed, their lives were threatened. They said if you said one word, your bones will be found in the desert by government officials. And, he said there's absolutely, 100% truth to the fact that it was an alien craft. And he produced the film. And, I haven't been in touch with him for a couple of years. But, when someone gets that close to a situation, interviews witnesses and everything else, you got to believe there's some truth to the whole thing about the cover-up and the Area 51 and all that funny stuff. So, we talk about it. People think you're nuts, but there is a cover-up of some event that occurred back in 1947. From what I hear, there's dozens or hundreds of other instances like this where governments around the world are covering up, things that have landed here. And a lot of our technology, apparently, since 1947 has been exponential. because of some of the things we've been able to reverse engineer from some of these craft that apparently we got our hands onto. So there's something to all this, and not to say that this has anything to do with the current hoax or crisis that we're having, but certainly, when I heard this guy on Fox News say, hey, we got to prepare for this as if we were fighting Martians, I said he might be thinking something that, you don't want to say, but could be happening out there. And again, when you say this publicly, they turn you off and they think you're like Paul Hellyer, and you're just an old man who's crazy. So we'll see. Time will tell, or maybe we'll never know. Maybe their cover-up is their ability to cover up is so great that it'll continue on for a long time to come.
Yeah, and Paul Hellyer, for people who may not be familiar with him, is a former Canadian defense minister who said he saw NATO documents saying that, aliens had crashed here and they had bodies hidden away somewhere. So, right. Mark, before we do end up being whisked away in a little saucer-shaped craft, do you think volatile markets are here to stay at least for the short term?
In my entire career, we've seen volatile markets. I don't expect to see that change at all. Volatility is the name of the game. When you say volatility, people refer to markets going down a lot. I mean, we can see upward moves too. We had a huge move just from December to January to the upside, where the market moves dramatically higher over a very short period of time. So this is how the big firms, this is how the big traders, the big players, so to speak, make money with volatility. So, we have the markets that I saw when I started my career in the 1970s, where, a 30-point up day was a big up day in the stock market, and we traded, I remember when I started in the business, we were trading days under 10 million, 10, 12, 15 million shares a day. I mean, compared to the billions that we trade now, the answer is yes. It's part of the game.
Are volatile markets a good example of investor psychology with greed versus fear and buyers versus sellers?
The answer is yes. Greed and fear are part of it, and it goes further than that. I mean, a lot of news is manipulated, to the benefit of the players that are, in the marketplace. You'll see good news at the top. In many instances, funny how stocks top out when, there's a lot of good news, and stocks will tend to bottom, or even the market, as we're now seeing when the news seems to be the worst, we're at lower prices. So very big component part of it. And, and manipulation of the markets is, again, part and parcel to the game. I remember one of the mentors that I studied with many, many years ago was telling me when he was a young man on Wall Street, I guess his time would have gone back to the 1920s. He was telling me he used to work as a runner and deliver checks to reporters to plant stories in the various big newspapers without mentioning names. So, just to get stocks moving. And greed and fear, manipulation, it's all part of the game. You just have to know the game when you get into it.
In 2007, the uptick rule was removed in the U.S., followed by the crash of 2008. In 2011, Canada decided to remove the uptick rule. The venture exchange collapsed a year later. There's calls for President Trump to reinstate the full uptick rule to return stability to the markets. Your opinion on that?
I think it would be a good idea. I mean, it would calm things down a little bit, but there's so many sophisticated strategies out now, particularly with the intraday trading that's going on and the computer models. I'm not quite sure if it would change anything. It would sound like we're trying to change things a little bit, but you have the futures markets. You'd also have to control not just the equity markets themselves, because there's futures on stocks, and you don't need to have an uptick in the futures to go short. You just hit the bid and you're automatically short if you want to be short in the futures market. So it would have to be, a broad-based regulation that things would have to uptick or be a zero tick before you can, play the downside. I don't think it'll happen because there's just too much vested interest in volatility in the market, and they'll be able to make money in both directions, and the big players want to have that freedom to be able to move both ways freely, and that's why they had removed it. And so, my gut feeling is that, yes, it might stabilize things a little bit, and you might see a little less volatility if it's back in again, because there's no question we've seen more volatility over the years. The powers that be that really run this business wanted that to happen. So unless Trump is so convinced that these forces, he can overcome these forces and he's doing the right thing, I don't think it'll happen, but let's see. But if it did happen, I think it would create less volatility. I don't think it'll happen, though.
A number of CEOs for major companies have resigned in the past couple of weeks or a few weeks. Could this have an effect on market psychology?
That's also a very good question. We know Bob Iger from Disney and Keith Block from Salesforce stepped down just in the last few weeks, and several notable CEOs have stepped down and announced that they stepped down or are going to step down in 2020. And I read some statistic that in January 2020 set a record for the most CEO departures in the U.S., which, according to this article I researched, there was 219 departures. And more than 1,000 CEOs have stepped down during the first 3 quarters of 2019. So what is this all about? They feel that the markets have topped out. That they feel that volatility was coming. It's a good time to cash in because many of these CEOs would still retain stocks that are vested to them, and they would still benefit even though they left their position. I guess the question is, why are they all stepping down? Why are we seeing so many resignations? Do they feel that politics are going to change in some way? We've had a Trump administration which has been pro-business, and maybe there's a sea change coming. If Democrats get in the U.S., perhaps they feel their positions or the control they would have would not be as significant, or they would be impaired in some way. I mean, I'm just speculating here. I don't really know, but when you see this amount of activity on the CEO side, you wonder what the heck is going on and why would they leave? So this could be part and parcel to something that we don't know about that's going on in the background in terms of world economies, in terms of political changes, other events that would force these guys to want to go do other things with their lives. It would seem to me they think something is coming that is not going to be conducive to them doing their jobs, obviously. So it is a little bit of a concern.
Was Japan in the early 90s a likely template for the low and negative interest rates we're now seeing around the world?
I hate to compare Japan to the United States. It's in a way, it's sort of apples and oranges. They had a super bull market in Japanese stocks when the U.S. was, suffering with, in the 90s, and they were sort of beating to a different drummer, I guess is the best way to state it. So I don't think it's a template at all. As you know, they've been trying to get their economy going, or they did try to get it to go for many years by keeping interest rates really low and trying to affect a lot of government policies, and for the most part they weren't so successful, where in the U.S. it seemed to have been more successful with those type of, central banking policies. So my answer to your question is, I'm not an expert, I'm not an economist in this area, but I would think that we're really looking at a different economy, different world, different factors, and I would not compare the two.
Is China's imploding economy starting to affect the rest of the world?
Yes, no question about that. I mean, look at the supply chain situation in terms of products being produced in China, which now we all are complaining about, that we depend too much on China. So everything from apparently a pharmaceutical ingredients to manufactured items and technological items. So their slowdown there has affected the supply chain, and we're frankly too dependent on China. And I think that the recognition has come now that we need to change all that, if at all possible, giving companies in the Western hemisphere, hopefully more incentive to produce things locally versus depending on a foreign situation which we have no control over. So it's definitely affecting the rest of the world, and it's helping, facilitate a lot of the shutdowns that we're seeing here because of what happened in China with the coronavirus. Of course, they seem to think they're turning it around over there, and the supply chains will open up again, which I guess is good short term. But I'm getting off a little bit of a tangent, but I guess the thought about this whole Chinese implosion and our dependence on them is causing a reason that we're going to start seeing a move away from dependency on China.
Should gold be displaying more strength right now?
A lot of gold bugs out there. I'm positive on gold, but we hit a cyclical time frame, which is just something others have identified besides myself. But generally, from mid-February to early March, you tend to hit a peak in gold, and you get the sell-off into the summer, and then you start another rally phase from the summer on. So I've been telling people in my metals and resource letter that, though I think gold could go higher later, you better be careful that we probably hit a little bit of a peak here in the February, early March period, which happened. We saw it first happen in the shares before we saw it in the metal itself. The other thing to mention here is, when liquidation in the markets occur, gold is not impervious to the downside. If margin calls, for example, are sent out and people have to sell something and they have to sell whatever is in their portfolio, some have to sell gold and to raise capital. And gold can move with stocks. They don't necessarily move inverse to stocks. In fact, most history shows gold tracks with the stock market. Doesn't necessarily go inverse to it, though. On some rare occasions, it does. It doesn't always do that. So the pullback in gold here is not surprising, and I would suspect it's following A, its seasonal pattern, and B, it'll strengthen with the regular stock market when the stock market starts uptrending again.
What are your thoughts on silver?
Don't like it as much. Too many silver bulls out there. Some of the short-term work we're doing says be careful here, in particular also on the cyclical comment that I just made. But I'd be looking at it perhaps later in the year, maybe in the summer or fall for maybe another trading opportunity on a pullback. I'm not in the camp, at least at present. Obviously I can change my mind in the next year or so, depending on what I see in the charts. But I'm not in the camp that says, silver's going $100 an ounce or anything like that. I know we have some predictions out there to $1,000 an ounce and all kinds of numbers, and maybe I'll come to see that over time. But even if silver comes back and has a nice rally at the end of this year into next year, I'd be surprised to see it over $22. Even if it got up to that level, but that's sort of where I'm at right now. I'd be a buyer in the next 2 to 6 months for a trade, but then I'm not quite sure how high it's going to go after that. We'll just have to monitor it.
What do you see happening with the price of crude?
Well, I predicted at the beginning of the year, and I did so at the World Outlook Conference just in last month, that you'd see a sort of a downtrending crude oil price. Of course, it came down with the stock market. Came down, of course, because of the China-Russian disaster that's going on, and the Saudi involvement in that. I'm sorry, it was more Saudi-Russia, I think. I'm sorry, not China as much. And so it's already come down. Politically, I think Donald Trump wants to see weaker crude oil anyway, though he did make some statement today in his announcement about the national emergency that they're going to be buying some crude oil, basically, I suppose, trying to support the market so that producers can be profitable, because it's got down to a level where frackers and others can't make money at these depressed prices. So whether he'll be successful in at least getting it up to a point that it's a break-even or in a more modestly profitable situation for producers, we'll see. But overall, my opinion was crude oil would be under pressure this year, because I think it's it's like having a tax credit for consumers. Having cheap oil, cheap gas prices is sort of it's like a tax refund or a break for consumers. So I think from a political point of view, keeping crude oil under control or more to the downside this year is more likely the case.
Do you follow the metals used in electric vehicles?
I don't follow a lot of them, but I do follow lithium, and there's a lithium ETF that we do track in our newsletter. So I think that's a long-term play, yes, and I do like lithium.
The cannabis market has turned into a roach. Could we see another bull market in cannabis stocks?
Every bull market and every bear market only lasts for a period of time, and the question is, how long is the bear market in cannabis going to continue? It started in April of 2019, and some of the shares are so depressed here, and a lot of it is it's a political call, particularly whether the U.S. is going to legalize, and whether if they legalize, whether it would make a big difference or not, since so many states have already legalized, and the federal government appears willing to accept the decisions on the part of the states and not interfere with their local businesses. So I don't think the U.S. is in a political mood to universally legalize it, though there's been some promises on the part of some of the Democratic candidates, and particularly Bernie Sanders. I don't know how Joe Biden feels about it, or Hillary Clinton, or anybody else who ultimately could affect the political forces here in the U.S., but even legalizing it across the board doesn't necessarily change the financial landscape. I think there's other factors. There's a lot of pushback conservatively on it. And then you have the Food and Drug Administration here in the U.S. that would probably be getting more involved, so getting it off a Schedule I drug to Schedule II or so. I don't know if it really changes the business for these companies or not. But to answer the long-winded response here, I think there is an opportunity in the market. I think the stocks got ahead of themselves, and whether they're going to get anywhere back to where they were back in 2019, and I don't think you're going to see that for a long period of time, but I think there are some trades here, particularly in some of the bigger names like GW Pharmaceutical or even Canopy Growth and Kronos in Canada, and some ancillary names out there as well. I think there's some money to be made since they're so depressed and they got overdone to the downside.
Could psychedelic stocks become the new cannabis stocks?
Yes. In fact, there's a lot of push in that area now. There was a big conference in Israel supposed to have occurred this month and got canceled because of the coronavirus, but a lot of money is being pushed into the psychedelic stocks. In fact, we added a few of those to our Canada Sector Report newsletter this week, both because the markets were down and because they're relatively cheap stocks. So this seems to be the new push now in the cannabis area, the psychedelic stocks, which are not so much, purely cannabis related. They have to do with, mental health of patients and using other substances to help people that need, those type of ingredients to get them better. But I'm not really sure if it's really a cannabis play, though a lot of the cannabis players seem to be getting into these stocks. So I would say yes, this is a new area. I'd be careful because many of them are very speculative and they're new companies. But if enough people start following them, there could be some nice trades. So as I mentioned a moment ago, we did add some names to our list, and people who sign up to the newsletter will find them there.
Are the cryptocurrency markets riskier due to no underlying value?
I think so. I think it's also too complicated for the average investor to understand. A lot of traders have been playing with many of the currencies, the cryptos, and doing very well with them, but many of them have been under a lot of pressure here. I don't think the government is very happy about the crypto market, and I think at some point you might see the one or more governments institute their own cryptocurrencies. There's been a war against cash on the part of governments for the longest time, Europe in particular, and more coming here potentially in Canada and the U.S., where the governments don't want you to have cash because they feel somehow you're doing something illegal, which may not be the case at all, probably not the case at all. And the crypto solution might be something governments may look to mirror and create their own versions and say, hey, no more cash, folks. If you want to do business, use this new Federal Reserve crypto or coin or Bitcoin, as they would call it, and this is the way you need to transact business because this way we can control cash, we can see what you're doing or not doing, and unfortunately it's more control and supervision over our lives, which as a libertarian and conservative I'm not too happy about at all, but that might be the ultimate direction where the whole Bitcoin crypto market will end up in government control, and but it is definitely risky. A lot of people have made money trading them, so as long as those are free markets and you can trade them and you feel you have a handle on them, I have no problem with you doing that at all. It's an area which definitely you need a lot of expertise in, and you really have to understand what you're doing.
How can people find out more about the Leibovit VR newsletters?
Very simple. Go to vrtrader.com. VR stands for volume reversal, which is my technical tool, so vrtrader.com. And when you go there, you'll see all our newsletters, and we have a bunch of them there. We have a metals resource letter. We have our cannabis letter. We have a market timing letter where we put out market timing signals, buy and sell for the overall market. We have market letters that cover individual stocks. We have our Trading Ace newsletter, which provides trading opportunities, sometimes intraday for those who are looking for a little action intraday in the markets. So we keep busy here, and that's the place to go, and I appreciate you mentioning it.
Mark, thank you so much for being on This Week in Money.
Thank you so much for having me.
My guest was Mark Leibovit, editor and publisher of the Leibovit VR newsletters, also known as vrtrader.com. He was speaking to us from Arizona. Coming up, Eric Hadik, next on This Week in Money.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Aben's 23,000 hectares Forrest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abenresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Eric Hadik, CEO and president of InsideTrackTrading.com. Welcome back to the show, Eric.
Oh, thanks for having me back, Jim.
Eric, in early February, you described to your readers a perfect storm of signals that were projecting a sharp stock market sell-off in late February and in March. Have we completed those signals?
Well, I think we're certainly getting close to the culmination of that sell-off. One key level to be watching is the late 2018 lows in the indexes, and that's really the deciding factor for a lot of these. But it's been kind of amazing to me to see the convergence of indicators and cycles that started to collide in late January and gave an initial sell signal, and then in early to mid-February give a much more powerful sell signal. And one of the things that I keep coming back to, and I've talked about it with you a few times over the last year or two, is just how uncanny this 40-year cycle has been. And I should even preface that by saying, number one, I don't try to trade off of a cycle of that magnitude or that long in duration. And I always stress that for me to have any confidence in a signal that I'm getting, I need to see synergy of multiple indicators and cycles showing the same thing. And that's what was going on in the first half of February. But going back to this 40-year cycle, it's just been kind of uncanny. In late 2017, early 2018, I described how I thought that there were a lot of factors lined up, and it was leading me to expect the action in 2018 to 2022 to be very similar to what we saw in 1978 to 1982. Both had been preceded by major sell-offs 5 to 10 years earlier. Both had then seen a recovery that was like that. There was a lot of different factors, and even the environment where things like gold and silver were concerned, and even geopolitical. And the end of last year, events with Iran just reinforced that 40-year cycle when, the U.S. Embassy was attacked in late 1979. The U.S. Embassy was attacked in late 2019, and conflict with Iran escalated in late 1979. It again escalated in 2019. But there's a lot of other things, and the stock market in particular, I keep kind of repeating and updating this sequence that we've seen. But, going back to the beginning of this 3 to 4 year period that I'm talking about, you look at 1978 versus 2018. In both cases, you saw a 6 to 9 month bottom set in the month of February, then a rally into the September-October period of both 1978 and 2018. Then in early October, you saw equity markets reverse lower and drop sharply, 15 to 20%, into December of both years, 1978 and 2018. In 1979, the structure of the ensuing rally was very similar. The Dow rallied in 3 distinct waves, peaked in April, and then saw a quick sharp sell-off. In 2019, same thing. Following that sell-off, in 1979, the markets rallied into the third quarter, retested the peak that it set the previous year in September, October 1978, and then had another sharp sell-off. In 2019, same thing. Dow went back up, rallied to new intra-year highs, and then saw a sharp sell-off. Coming into the beginning of this year, I started to describe why I thought that this parallel was going to continue to unfold. And in early February, it was becoming that much more intriguing and uncanny. And so I described in these articles on the perfect storm of sell signals, was what I was titling the one article, described how in 1980 the Dow recovered to new multi-year highs and peaked on February 12th, 13th, depending on the high close or the intraday high, and then saw a sharp, just an 8 to 10% plunge into the end of the month, so just a 2-week sell-off into late February, and then a much bigger overall sell-off into late March, which had it dropping about 20%. And along with a lot of other indicators that were showing the same thing, I kept telling my readers to look for 2020 to be remarkably similar to 1980. So what happened? The Dow went in, peaked on February 12th, 13th, exactly when it did 40 years earlier. The Dow had a sharp 8 to 10% drop into the end of February, exactly what it did in 1980. And the Dow had a little bit of a bounce and then plunged in the month of March, dropping over 20%, exactly what it did in 1980. And so this 40-year cycle has just continued to parallel these two periods. And again, for me, it's just been amazing to see the similarity of these periods. But there are many other factors that go into that. I described a foreshadow signal, which is a very ominous signal that my work generated in late January, early February. The sell-off, the initial sell-off we saw in late January of this year, was something that warned that a much higher magnitude top was already taking hold, and we were about to see a much sharper sell-off, what I described as the Dow would see the largest drop it's seen in at least a year and potentially longer over the course of that February-March time frame. And there were a lot of other indicators. In fact, I'd be happy to send a copy of this perfect storm report to any of your listeners if they want to be able to kind of unpack that a little bit more and understand what I'm describing. But it was, more than anything, it was the synergy of all of those factors that led me to expect a sharp drop. And like I said, we're now coming into the price objectives and major support levels that should really determine if this is the extent of this, and we're going to re-enter a bull market after wounds have been licked and some time of consolidation, or if this is the first shoe to drop and down the road we can start to expect a second shoe to drop. And on that note, I should say that one of the most critical things I use to determine that is a weekly trend indicator, which is into the point where the weekly close of March 13th will have a very strong impact on expectations moving forward.
Are we likely seeing the beginning of a bear market for stocks, or just a 20% or so correction in an ongoing bull market?
Yeah, and I would have to say at this point I am not certain of that. From a broader perspective, I've talked about how 2020 should have a major top, and my focus has been here again. It's related to this 40-year cycle, as well as a lot of other work that I follow. But my outlook has been that 2022 would be the next major bottom in the market, just like you saw in 1982 and just like you saw 40 years earlier in 1942, where we saw multi-year and what turned out to be multi-decade lows set at that time, and then new advances from that. But that's a long time from now, where trading and investing is concerned. And so I've thought and described how I said we could see multiple 15 to 20% corrections in this time frame. And so I think we're going to see more of a wide sideways market, where you see very sharp rallies followed by very sharp sell-off, and that we've entered a new phase between 2020 and 2022 that again could resemble in some characteristics what we saw between 1980 and 1982.
What are the cycles saying about the market volatility and where we're going from here?
Well, it's kind of like I was describing there, that obviously when you see volatility to this extent, the market needs to take a breather. So we get a final blow off low whenever that comes. It may be taking hold now as we're speaking. And that things almost have to start to retract a little bit as far as volatility is concerned. But I think that with the different industries that are getting devastated by the coronavirus, that you can't expect things to just suddenly and magically recover. So it just lends itself to a lot of volatile, more sideways trading if you're looking at it on a 3 to 6 month, 6 to 12 month basis, where you'll get some recovery in those industries and you'll have some decent rallies, but then reality starts to set in, and then you peak and plateau, and perhaps another shoe drops down the road 6 to 9 months from now, maybe sooner. The next couple of weeks should start to give a little better indication of what I expect timing-wise throughout the rest of the year.
Do the Dow, S&P 500, NASDAQ, and Russell 2000 have different cycles?
In some respects they do. When you're talking about short to intermediate term cycles, they will definitely see peaks and lows set at different times, and I suppose I should describe cycles in that way, because sometimes people just interpret the term cycles as the general ebb and flow and swings in the market, whereas I'm taking it more specifically than that and talking about specific turning points and the distance between those turning points. So in that respect, they definitely have slightly different cycles. Really, the canary in the coal mine for me, and I described this throughout late January, was the transportation index. And, this was before people really began to understand the implications of coronavirus. But the Dow Jones Transportation Average for the last 6 months has been showing that it was setting a secondary top. It has never gotten back to the levels of a few years ago. And one of the most consistent cycles it has had throughout the last 2 years was an 11 to 12 week cycle. And that told me, and I conveyed to my readers in January, that the transportation average should see its peak in just after mid-January, and then it should enter a 6 to 8 week very bearish cycle. And sure enough, the transportation average peaked before all of the others, saw the sharpest decline in late January, and that was the warning signal, and again, the canary in the coal mine, for the other indexes. And that's why I described why I thought that all of the other indexes would peak in the middle half of February, some of them at higher highs, some at lower highs, and then see a much higher magnitude sell-off begin after mid-February. So the cycles have some distinction between them, but the general larger overriding cycles are certainly more consistent. And actually, even with that, I would say one of the other interesting things to me, and one of the fronts, if you want to use the perfect storm analogy of converging fronts, one of the fronts that I was also warning my readers about was that late January, early February, actually through January and into early February, the market was looking remarkably similar to September of 2018. And what I meant by that, and what I described by that, was that I thought the FANG stocks, FANGs plus Microsoft, were artificially supporting the market, that you were back to that scenario you had in September of 2018, where the majority of the gains being seen in the S&P 500 index and in the NASDAQ index were the result of just a few key stocks that were continuing to surge to new highs, even as the majority in number of the stocks in those indexes had already peaked. And that was an additional factor I described in early February that was a big warning sign for me and told me to look for something similar to what we saw in late 2018.
You mentioned disease cycles in your newsletter. Do black swans appear in cycles, and is coronavirus one of them?
I do think that cycles certainly identify, pinpoint the time when these black swans do appear. In many cases, that they're not specific enough to, tell you exactly what to anticipate. But I recall one of my readers back in mid-2016, he had been getting my newsletter and was seeing how I had all these cycles related to Great Britain and the British pound, and they were all telling me to look for, number one, to look for Brexit to pass, because it would have this devastating effect on the British pound initially, And there had been this very consistent 8-year cycle in the pound. There had been an overriding 40 and 80-year cycle in geopolitics where Great Britain was concerned. There was a whole host of things. And so throughout the first half of 2016, I kept describing how from June to the end of 2016 was likely to see these types of events. The pound crashing to new multi-year, multi-decade lows, and then setting a bottom in the very beginning of the ensuing year. But those cycles themselves didn't tell you, okay, Brexit is going to happen. Now, once you overlay those cycles onto current events, you begin to see what would be an obvious manifestation or fulfillment of those cycles. So, in that case, you're able to take it a little more specifically. But, yeah, with disease cycles, here again, it's something where the synergy of so many things is what's important to me. And I would even go back, try and do this real quickly, but in 2006, I did a series of articles on disease cycles. And I explained at the time how one of the interesting things I had noticed was that there was a very consistent and persistent 10-year or decennial or decadal cycle in a lot of the influenza and influenza-related outbreaks that had been seen for over 100 years. And they dated all the way back to 1889, 1890, when you had this devastating Russian Asiatic flu, an outbreak of it. Then 1918, 1920 to 1920, where the Spanish flu was really the worst we've seen in over a century. And on a consistent basis, the very end of each decade, the 8 and 9 years, and the first year of the ensuing decade, the 0 year, had continued to see these type of outbreaks, and that flowed all the way through to the Hong Kong flu of 1968, 1969. And at the time in 2006, that, along with some other longer-term cycles, had me, what I published then was that I thought 2009, 2010 would be another major outbreak. Well, lo and behold, here comes swine flu, H1N1, an outbreak in 2009 and lasting into 2010, which just reinforced that 10-year cycle. I also described at the time why it's very common that a lot of these major outbreaks also tended to coincide with the low in the solar cycle. And, when sunspots are at their lowest, and there's been, they've done on a major basis, they've shown how on multi-century basis, the real low points or naders of the solar cycle have coincided with much broader, more long-lasting disease outbreaks, but also on an individual basis, each 11-year cycle, which is what the sunspot cycle is approximately, that's the periodicity that it runs on, that you've seen many of these outbreaks coincide with that low. And the 2009 outbreak was in perfect sync with the beginning of solar cycle 24. And there were also some other things at the time I discussed, even back in 2006 through 2009, discussed a overlapping 17-year cycle that was not coming into play right then, but was something for the future. So you have the swine flu outbreak. And then in 2014, I had several readers kind of asking me to do an update on that because Ebola was breaking out at the time. And so I updated those cycles and explained that, that 2014 was certainly not on my radar with some of these diseases. But what it was still showing me to look for is that the next phase of the 10-year cycle would be back into play in 2018 through 2020, And even back then, they were already projecting the low of the solar cycle when solar cycle 24 would end and 25 would begin. They were projecting that for 2019. But that was also the next phase of this 17-year cycle of disease, which, funny enough, also ties back to the Spanish flu of 1918, 1920. And if you move forward in 17-year increments, you had overlapping cycle of an influenza epidemic in the 30s. Then in the early 50s, there was what was known as the Liverpool flu outbreak, which really hit England and Canada more than anywhere else. But 17 years after that was the Hong Kong flu of 68 to 69. 17 years after that was the Taiwan flu of 1985-86, an outbreak of influenza B. And then 17 years after that, 2002 to 2004, was SARS. And so that 17-year cycle was also projecting 2019 to 2021, which is 17 years after the SARS outbreak of 2002 to 2004, as a major outbreak. And so you had already these three converging cycles, and there was a broader 100-year cycle that, you know, goes back in times, a major cholera outbreak of the early 1800s, the 1820, and before that, the last major outbreak of the plague in 1720. So it was this combination of all of these long-term disease and influenza cycles that really had the focus on circulating or surrounding 2019, 2020. So, you know, there certainly is some indication that these cycles can give you some idea. They're not going to tell you where it's coming from, what it is specifically, how bad or not bad it's going to be, but they do give you some indication of what to be looking for.
We'll have more with Eric Hadik when This Week in Money returns.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with Eric Hadik. Eric, do cycles tend to mirror or rhyme?
That's one of those $64,000 questions, but I would say rhyme. I would definitely say that, you know, they don't, events and market moves don't repeat with precision, and it's whether you view life as kind of a circle where you just go around 360 degrees and end up back where you started, or you view it as a spiral where you go around 360 degrees, you're now very close to where you were at the previous phase, but you've progressed, or in some cases maybe you've digressed, to a different level. So same thing in the market, that you'll come back around to a similar expectation, a similar time frame, but they're not going to be precise. You can, even when I describe this 40-year cycle, it has kind of amazed me how precise and how accurate that long term of a cycle has been, and has been able to project some of these moves in the stock market. But I don't expect things to continue to be in that close of lockstep with what the previous cycles witnessed.
For the past year, you've forecast early March 2020 to time an important top in gold. What do you see ahead for gold and silver?
I think that gold and silver have reached a major crossroads, a coincidence and convergence of Long-term cycles, for the last several years, I have described this, what to me has been a very uncanny cycle in gold, and it's about a 12.5-month cycle. It ranges often from about 52 to 54 weeks up to 59 weeks. And it has timed many of the most significant turning points of the last 4 to 5 years. But the really interesting thing to me is that has represented a web of cycles, which is really what you do expect from cycles. But there has been when you start to break that cycle down, there's been a 27 to 29 week cycle, half of that larger degree cycle, and then there's been a 14 and a half week cycle, and many times you'll even see a 7-week cycle come in between those phases. And all of those, for the longest time, have been telling me to look at early March 2020 for a multi-month top in gold, and silver had already shown that it was much weaker and had given sell signals ahead of time in gold, and the gold stocks too. They were also leading that. But the recent action in gold and the spike up to a slight new high in early March fulfilled that cycle perfectly and gave the kind of divergence that you look for from significant turning points, where silver was at a much lower high, the XAU was close but not able to really extend its rally. And so all those things were coming together, reaffirming what I have been describing in my publications for the last 8 to 12 months, that March 2020 was really the critical cycle to watch where gold was concerned and where a significant top was concerned. And it was funny, even as you see this meltdown in the stock market unfold in the early days of March, and I'm getting a lot of readers questioning me and saying, if this market melts down the way you're expecting, gold's going to just keep going up and up, and because it had been shooting up on safe haven status. And I couldn't tell them exactly the reason why both were going to be in bearish cycles in the first half of March, but all of a sudden you start to get this sharp sell-off in gold, and you hear that there's, some selling to cover losses in the stock market. So all of a sudden the safe haven play is overwhelmed by the need for some larger entities to be covering losses and selling out some gold, and it had run its course. I mean, the uptrend had stretched to such extremes that it almost had to go down. And then entering this week, March 9th, 10th, everything was showing that gold and the XAU are in for an even bigger sell-off, leading into some daily cycle lows that come into play in mid-March, but then some weekly and monthly cycles that are coming into play in April and May. So if we see a sharp enough sell-off into mid-March, that will really validate that, and it'll also start to hone the outlook for April and May.
What do you see ahead for the U.S. dollar?
I think the dollar is going to continue to vacillate in here. You get a combination of reactions to everything that's going on in the market, sometimes flowing into the dollar. More recently, you've seen a big spike up in the yen as kind of a safe haven currency, and the dollar suffering. But the yen has also spiked to extremes above 99, where a pretty significant top could take hold there, and the dollar has spiked down into March 6th, 9th to where it's due for a decent bounce. But looking out over the coming months, I've been describing where I thought that late March and late June would be the next two significant lows in the dollar. So what I'm kind of looking for is a pop up into mid-March, and then maybe starting March 16th, 17th, a new sell-off taking hold in the dollar and extending into late March and ultimately into late June.
Is the pullback in crude part of a cycle?
Oh, most definitely. And it's not just cycles. You know, in all of these things, I use cycles as a backdrop. I use them for to give me some general timing and even direction of an overall cycle in a market. But it's specific technical indicators that make my decisions and validate those cycles, even tell me if a cycle's extending a bit or narrowing some. And there has been a monthly trend indicator that in crude that I've been talking about the last 6-8 months in my monthly newsletter. And the one major conclusion from that indicator, and a lot of indicators I use have one or two purposes, and that's it. Then I look to other things to give me more specific clarity. But the thing that monthly trend indicator kept telling me was that crude still had another major sell-off in store, and it had to break below its late 2018 lows and then move back towards its early 2016 lows. And from a cycle basis, I thought and still think that the time frame with the greatest synergy of monthly and yearly and weekly cycles is in mid-2020. June through August is kind of how I define that based on a very consistent 17 to 18-month cycle and a host of other cycles. That's when I think we'll see a final low, but we're really seeing the majority of the sell-off now. And what I've described is that I think the price level of $26 to $28 a barrel will continue to be major support. That's where the market bottomed back in 2016. It's the support that once crude broke below that late 2018 low and fulfilled the monthly trend, there were wave objectives and other targeting tools that were reinforcing that $26 to $28 level. So from a timing cycle standpoint, I think a final low could wait into the middle part of this year. From a price standpoint, I think we're getting very close to where a bottom will ultimately be set, most likely in that $26 to $28 range.
Eric, is there any way to sum up what we're seeing right now?
Oh, I don't know if I could do that very succinctly. I do think that it is a recalibration and reassessment of some things that have really gotten out of sync and stretched to extremes, like in the stock market. And of course, every time you stretch to one extreme, the reaction goes too far in the other extreme. So, you know, right now, I think we're in the midst of that big snapback that you see as the market is trying to find the true equilibrium that's there somewhere. And so I think that's where we're at now is the search for equilibrium and a more accurate pricing model of the future, of what's coming in the next 6 to 12 months, next 1 to 2 years. And I think the market's going to be seeking out that equilibrium for some time.
Eric, can you tell us a bit about InsideTrackTrading.com? Well,
I think our discussion is probably the best description of that, we provide a host of not just cycle analysis, but technical analysis. Again, I would stress that the cycles are just a backdrop, but it's many of these technical indicators that really have been the most important aspect of my analysis and my trading. And so we provide publications for anyone from long-term investors who just want a monthly publication to some that maybe want a little bit more than that. So there's a monthly publication with a few intra-month updates that still focus on the broader perspective. And then we've got a weekly publication with intra-week alerts for the more trading intensive readers and investors out there. So we provide those publications, and also we really model ourselves as being educational as well, to where there's frequently tutorials given in the publications on how to apply specific indicators, how to use them in your own trading, kind of that adage of not just giving fish, but teaching how to fish. And that's really our biggest goal here.
Eric, thank you so much for being on This Week in Money.
Thanks for having me back, Jim.
My guest has been Eric Hadik, CEO and president of InsideTrackTrading.com. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Mark Leibovit, and Eric Hadik. And thank you for listening. If you have any questions for the show or our guests, you can send them to info@howstreet.com. Now stand by for company showcase updates from American Manganese President Larry Reaugh and Aben Resources CEO Jim Pettit. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and president of American Manganese. Welcome back to the show, Larry.
Well, Jim, it's got a real rough market, but it's still great to be able to communicate with people on the show.
Larry, now I'm sure your office is getting calls from concerned clients about how the markets are affecting your operations. How are things going there, and what do you expect to happen?
Well, it's we're getting calls and emails and all kinds of different communications on the market. Certainly, everybody's concerned. I don't think. I can only speak for myself, but I'm not concerned because I know how solid our technology is. And I know that we will come out of this on the other side looking better. But, the market is, with the coronavirus, has really taken on a life of its own, and which is actually, should I say, a death of its own. And, people are getting concerned. Our stock is, down about 40% from where it was. And that's not always a good thing. That's not a good thing at any time. And but we've got lots of company in that. Just about every other stock out there is trading in the same way. What makes this correction or this market slide different from anything else? Well, certainly the venture exchange has been affected very negatively. We're down below, I think we're at all-time lows right now. We've never had a real comeback from the 2011 slide after the uptick rule was removed. We're seeing that, that Toronto can almost equal the losses in a day that the Dow has, and when the Dow's twice as high. So, that tells you something more about the fact that, that short traders are having their day in the sun. And, I look at the volumes on our stock, right up until Monday of this week, we were holding our own for the first week and a half of the, market correction. And, then we got hammered and, hammered down to, 11, 12 cents. We were down lower than that yesterday. And, should people be concerned? Well, yeah, why wouldn't you be concerned, in a market slide like this? But what you have to look at is you have to look at the, fundamentals of the company or the company stock that you hold. And if the fundamentals are good, that stock will survive and probably get better. Now, our fundamentals are solid. We've got, we're continuing with work. We're not, basically, if I was to put out a release today, just to generate more, probably short selling. And, I've been through that before in 2011 when good releases generated, 30-40% falls in the stock. So, we're not at the heights that we were at that time, but, we're certainly getting bruised just like everybody else. But I'd like to assure everybody that this recycling thing, we talk around the world every day. This recycling thing is becoming more and more prominent out there, and somebody who has the magic pill for it, and we do believe that we have that, is going to be very, very prominent at some time this year. So, like I say, I'm not exactly losing sleep. Sure I lose sleep, but I'm not exactly worried about it. Just remember one thing: worry is debilitating, and we can't afford to be debilitated at this time. So, worry is something you put on the shelf, and you just keep plugging ahead and doing what you do, and you'll get through all this. So, what I'm saying is basically if you look at the volumes in our stock, which have increased, you'll see that they're almost matched by the volumes on the OTC U.S. exchange where we trade. And so it tells me that probably 60% of our volume is arbitrage, which means that there's not as many people panicking and selling the stock as you might think out there, but the arbitrage is designed to move us down. And, if you know anything about markets, you certainly understand exactly what I'm saying. I know people don't like me to talk about predatory trading, but this is their day in the sun, and this is a perfect storm for them. So, we just have to fight our way through it and hope that, that some wiser heads take advantage of looking at this market and say, hey, we got to get the uptick rule back into Canada. I mean, this is crazy. And, everybody should be very upset. This is the time to be lobbying the exchanges and IRAP to IROC to basically say, hey, we got to do something and get the uptick rule back, because the stability of the economic markets in Canada are in peril, and they are. I mean, nobody wants to buy a Canadian stock. Nobody wants to do anything in Canada anymore. We've made it wide open territory for people that don't have the best interests of the companies or the economy or anything else in heart. They're more interested in destroying it. So this is kind of a dilemma that we're in. Moving on the brighter side, we're continuing work on our with Cometco, and I would hope that we'll have something out. There's a lot of interruptions that are going on with the coronavirus, and but we're maintaining our places at our desks in Surrey. So we will be putting out news as it comes forth, and I think there's a lot of stuff backing up in the chute that we'll be able to announce here very soon. We've had some very exciting times in some of our conference calls, and so I can say that is ongoing. And our success rate is ongoing. Our work on our patents is ongoing. So we're in good shape. Those patents really do put us in a strong position to recover in this market. So that's the message I want to leave with everybody, and I want them to know that it's not all just market action. You've got to realize that if I was a Predator trading, I'd be creaming it for everything I could get, and certainly there's billions of dollars being made every day on the Predator side, and there's billions and billions of dollars being lost on the investor side. But that too will change, and sooner or later we will get a handle on the coronavirus and get on to business as usual.
Larry, can you give people a little thumbnail sketch of what American Manganese is all about?
Well, American Manganese is a critical metals company. It's developed patents in the manganese space for very low grades of manganese, and we use that as a cornerstone to start research and development of our battery recycling. We've had tremendous success, and we're very transparent about it so that people can see that the company what they're doing, and that everything's arm's length, that there's nothing being cooked in the background, and there's no way to actually fabricate any news on this. So and we've got this is being recognized out there. So we're traded on actually you can get information on us at our website, AmericanManganeseInc.com. We're traded on the Toronto Venture Exchange under the symbol AMY. We're traded in the U.S. under the symbol AMYZF. We're traded in Frankfurt under the symbol 2AM. You can contact the company or myself here at LREAUGH@AMYMN.com, or give us a call at 778-574-4444.
Larry, thank you so much for the update.
Thank you.
I've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on March 13th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm speaking with Jim Pettit, CEO and President of Aben Resources. Welcome back to the show, Jim.
Thanks a lot, Jim.
Jim, it must be March madness around the offices with spring right around the corner.
Well, it's there's no shortage of things going on here with the now confirmed pandemic, and the markets are a lot of fun, and they're interesting to watch right now. It's just anybody's guess. But we're moving ahead. We've got lots on our plate through this off season of drilling, and we haven't put a news release out since November. So the guys have been just compiling data, reviewing the data, and coming up with some interesting drilling plans for this coming year up in the Forrest Kerr.
And what are those plans, and where exactly are they taking place?
Well, this is going to happen up in the Forrest Kerr. Our property there is called the Forrest Kerr. So it's in the Golden Triangle, northwest quadrant of British Columbia. We've done, in the last 3 years, 20,000 meters of drilling. We have a confirmed high-grade zone. Last year we moved away from it, and it showed us that it's fairly constrained. We're very curious as to where it came from, because that whole valley is very highly mineralized. And as we move south, away from it, testing some of these geophysical structures that we see now, that we did a airborne mag survey last May, and we tied in a lot of these structures that show up with the drilling off the flanks of them, to see what we would come up with and how they relate to some of these fault structures we see. And we ended up coming up with an awful lot of good low-grade intersections, like broad intersections of lower grade. Not necessarily what we're looking for. The market certainly wants high grade. So going forward, knowing what we know now, with the extensive drilling we did do last year, we realize now that there's another fault there we weren't terribly aware of, or at least not paying attention to, because it didn't have the ground geochem associated to it. But as we drilled south, we now realize that it's called the Benchland Fault. It's as you drill along it, there's a lot of mineralization, and it looks like it's coming off that fault. And that's as we move south. If we have a pretty sweet target to try to figure out what's going on in the high grade zone, where it came from, that sort of thing. It's just to the west. It's across the Creek Fault, which is in the bottom of the valley. And it's got our interest, because we're looking for a heat source, because that whole north boundary area has got some, as well as the normal, alteration. It's also got potassic alteration. And as you move south, that potassic alteration goes away, and that's generally associated to a heat source. So it's there somewhere. And there is a very large anomaly across the Creek Fault from where the north boundary is. It hasn't been tested. It's blind because it's covered in scree, but it shows up, and it's very large. So that's going to be one of our targets next year, trying to isolate that a bit and figure out if that's a heat source, or drill deeper underneath. And then as we head south, we've got this new fault that looks to be controlling an awful lot of mineralization as you head south. So there's a fair amount of work ahead of us. We're just fine-tuning some things right now, and we'll be ready to go.
Now, Jim, some of the analysts I've been talking to say even with a market meltdown, gold juniors, for some reason, and you probably know why, are still holding in there, because I'm sure with gold being seen as a source of security, the source of that source is an important thing to have around.
Yeah, it is. It's if we can prove up something like that this coming season, it'll change the game for us. We've held our own during this downturn. Indicates to me that we're every season after we finish drilling by November, we're at another low. And then it comes back again, May, June, July. And depending on, what we come up with, it will dictate if it'll stay up there or come back down to these traditional lows. But it's been fairly consistent. Last year it didn't hit the highs that you had the previous 2-3 years. But that was just because the grades were not the high grades that the market wants. So, I get it. We are already sitting at our lows, so we're not getting influenced a whole lot by the downturn in the markets right now. Whereas a lot of guys with much higher market caps, they got room to move down. And they're coming down. There's some pretty good buys out there when this is all said and done.
Is that an important message, for people to know? Plus, we know people like John Kaiser is trying to convince people under 55 that mining's a great place to invest your money. Look at how the cryptocurrencies and marijuana have not worked out for them.
Well, as long as they sold, it worked great. That's the same old adage. I know what John's saying. It's we're looking at let's put aside this pandemic right now, and the oil fight between the Saudis and the Russians. You know, we have a really good market underlying it all. But we also had a resurgence in gold, and you had a lot of the juniors starting to move up. Now that's reversed, but I think they'll be, once things settle down, I would think that you'll see gold starting to move again, you know, because we've just been through a couple of weeks or a week and a half of throwing the baby out with the bathwater because, you know, margins were called. When that happens on a big scale, like in the States on the Dow, they have to sell everything to raise money to cover their margins, and caught everybody off guard. And so gold gets sold. Everybody's asking why is gold going down? Well, it was getting sold heavily because it was one of the only assets they had left they could sell, and that's, you know, on a very, very, very grand scale.
And again, a lot of the people we've been talking to are very bullish on gold long term. And again, mining isn't something you do for a day and then walk away.
No, no, not at all. You know, as time goes on, it takes longer and longer to take a discovery through to production. You know, minimum 10 years now. It's probably greater than that. I'm not really sure, but, you know, 10 to 15 years. It's a long time. Like the time frame's much broader than most investors. So if you're lucky enough to be involved in a junior that does have a discovery and can take it further along, that's where your greatest upside is. So, you know, that's generally why people are looking, and why John is saying, you know, they should be looking at this. We're looking at a market that, all things being equal, is actually, you know, it should be a good market, but we've got these roadblocks in the way right now, and I think it's just a matter of time. Gold will, you know, it wants to go higher.
Jim, can you give us a bit of a background for Aben Resources?
Well, Aben's a gold exploration company. We've got our flagship property is the Forrest Kerr. We've still got the property in the Yukon, and actually north of the Justin property, we've got another one called the Hit, which we've never talked about. But they're in an area where, you know, you've got a company like New Gold that's up there sniffing around on the NWT side of the border, because those properties are right situated on the Yukon NWT border. So there's interesting things going on quietly up there. So I don't want to disregard them. We had disappointing results out of the Justin last year because we used a RAB drill, and you can't have groundwater interfering with that. And we did. There was a lot of artisanal water underneath, and it inhibits what you're doing with the core. Like a lot of the heavy metals will get shaken out, and you don't get representative values in it. Anyways, that was, you know, tough luck to us at the time, but you know, it's still there. It's a good property. I'm more inclined to find an option partner for it. It's a good property, and it's a qualifying property for, you know, anybody who's doing an IPO or anything like that. So it's still of use to us. And then I've got still got an interest in the property in Saskatchewan, the Chico. We started that a couple of years ago, and ended up the natives weren't happy with us being there. It was one of those classics where, yeah, we consulted, we did everything we could do, and had a permit and started work, and then they're in the middle of election, and so we just, you know, they didn't want us there. They want us to come back now, so I'm kind of thinking about that, but I'm thinking very heavily about that. And at the same time, there's other evaluations going on, so that's what we're doing right now.
Where are you traded, and where can people get more information?
We're traded on the TSX under the symbol ABN, OTCQB. We're trading under the symbol ABNAF, and on the Bourse Frankfurt, E2L2. And they can go. The best place to get information is the website, AbenResources.com.
Jim, thanks a lot for the update.
You bet. Thanks.
I've been speaking with Jim Pettit, CEO and President of Aben Resources. I'm Jim Goddard. Our conversation took place on March 11th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.